Good morning. 1/5/2012. Time 8:52 a.m. Pacific Standard Time, Saturday. We believe that the VIX, which is a volatility index, and we've covered it right here, up here, market volatility, CBOE. What we really want to make clear to people is how complacent the markets are. The S&P has done exactly what we thought. If they got a fiscal cliff deal in the short term, we could pop back up toward 2012 highs in the S&P. And when we were just very not long ago here on this monthly chart, the last high was 20 something up here. But when we get down here to 2007 lows, you can see what happened to the VIX. What it is, it's a fear indicator. What it means is people are complacent. What it means is that people don't have any fear. And they think that whatever their thought patterns are, but they equal less fear. And when this goes lower, markets go higher. And we're down here at monthly lows. On the weekly chart that I'm going to show here, you can see what happened when we got that fiscal cliff deal. That fear indicator, which was rising and breaking higher all the way up here, I'll draw a trend line for us, that was the highs up here at 23. We've dropped 10 points. We're right back here where the fiscal cliff and where we broke out higher and where we're at complacent levels where corrections happen. It had a weekly buy signal on the VIX. It's a fear indicator as far as directional price movement. One of the things that we're going to look at here on the VIX is if the VIX goes higher, you can buy calls. And we're going to take a look at the January $20 calls right here on the VIX. They're cheap. It's the best time to buy them when they're down here for one reason. That way, if you are involved in the market sell-off and this thing breaks higher, you have a hedge to get paid on the upside when the VIX goes higher and equities sell down. And we're going to go and teach a lot of different courses around volatility, but particularly you want to have some of these up and out of the money calls in February when they're cheap. And I can show you what cheap is. I'll pull up a daily chart here and show you where the $20 call was. The $20 call broke up here, and this is a daily. So 1, 2, 3, 4, 5 days ago, these were right up here. And the price up here is $3.68. Right now, this particular one is a February $20 call. It's on sale. Just as I always tell people if I'm training a new hedge fund manager or money managers or new MMTs or whoever's coming into the marketplace, they're on sale. And we will be purchasing the $20 call. You can see how on sale it is. If I go over here to the $15 call, or the $17 call rather, 1, 2, 3, 5 days ago, these were up here at $8.55. They're on sale down here. And the reason why we're using the February contract is because it's a great place to have when we're this complacent on the weekly chart now that I showed over here. That's this weekly chart here. We got to start buying those again. We traded them from here all the way up and then sold out of them. And there was some big trades when they were on sale and some big profits. That's the weekly chart on the VIX. If I show you here, we're down here at levels going back to 2000, below 2010. This is where complacency, no fear, but bam, you get market corrections. Bam, you go up. Now we're right back down where this whole bottom side of is a major support level. And that's on the weekly on the VIX. These calls that I'm talking about right here, which will be in our new alert service. There are certain alert services that people pay for, and they can get these trades. The thing about it is, we're buying them cheap. We'll be looking at the $17 call. Everybody needs a little volatility when these things are on sale. Last time when they were on sale here, they were somewhere right around, let's say $1.80. And then they made a great move up here to the high of that bar, right around 480. That's a $3 move. And when you're buying the contracts for volatility and you've got, 30 of these contracts and you just made $3, you made $9,000 when the markets were selling off. This was going higher. And that's when the fear stopped. When they got the fiscal cliff deal, you can see how they came all the way back down, and now they're at all-time lows in the February contract. We will be buying the bulk of them at our special discounted market maker prices moving forward.